Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, I'm super honored to welcome one of the greatest of all time when it comes to passive income investing, Adriano. Welcome to the show, Adriano.
Thanks so much for that great introduction. I certainly don't feel very great. I have a cold right now, so I apologize for my terrible voice.
There's a lot of following for you, not only on YouTube, but also on Blossom. You're one of the Blossom ambassadors. Why don't you maybe provide a quick introduction of who you are, and we'll take it from there.
Sure. I mean, I'm Adrian, about to turn 40. I was in the IT industry for a really long time, for about 10, 15 years, and became financially independent in 2019, the end of 2019.
Oh, wow.
I was 34, 35 years old, 34, I believe, then. So I'm married. My wife and I, Erica, started the passive income investing YouTube channel shortly after we became financially independent. So early 2020, I believe, is when we started. And it was a bit slow, but the idea of the channel really was because people kept asking us, friends, family, and other people, whatever that we would meet, how is it? What do you mean you retired early? Or how's that even possible? What do you mean you live off of your investment? So instead of explaining it every time to like one or two people for an hour, and at the end of that hour, they don't understand anything anyway, the idea was born. Why don't we just put it on YouTube, create a YouTube channel? And that's how basically it started. But in terms of, that's the channel. But in terms of investing, I would say I really only really became an investor, understood what that actually meant in 2017 or 2018. I can't remember the years now. I get messed up. But basically, from 2011 to 2017, my wife and I were both working in the IT field. We don't have kids, so we had quite a bit of disposable income. We're always hard workers. We would always take overtime if they would offer it, and there was a lot of overtime opportunity, pager opportunities. And eventually, we moved up in the company. We both became managers, so we had a pretty good salary. Now, in today's terms, that salary wouldn't be anything special, but for us who grew up, regular, normal working class family, it was really, really good for us, right? So I was speculating or swing trading. That's what I really was doing. I didn't know at the time what I was doing, but it was just more for fun on the side because I did have some disposable income. So I would basically buy companies or stocks that were really, really down, and Canadian companies that I really knew, like Bombardier, BlackBerry, Air Canada. That was one of my biggest wins. And it's funny because later I went and worked for Air Canada.
Oh,
It was pretty funny if I would have held on to that stock, but of course would have, could have, should have, right? I bought at $2 or something like that. So,
oh, wow.
so basically I was just buying shares of companies I thought were undervalued or were struggling. And then I would just sell them after a few weeks, a few months, just to make a profit, right? So that's really swing trading. In my opinion, it's not really investing. But the bulk of our disposable income, here's the main story that I tell all the time, went towards paying down our mortgage. So our 20-year mortgage was paid off in 7. So 2011 to 2017, 18, our mortgage was done, or was about to finish. And that's the trigger of when I really started looking for, okay, what am I going to do with even more disposable income? What are we going to do? So that's when we started doing some research, and I discovered Kevin O'Leary talking about dividends. So I started getting into dividend stocks, and really the whole idea and concept of just investing in something, holding it forever and getting paid started. So I would say that's the roots.
And at that time, were you thinking that, you're going to be retiring, let's say, much earlier, around
No, no,
34, or no, the idea hadn't really
that's a
born
good
that time?
question. So retirement is a very misunderstood term, I believe. The way it's, people think you're just going to do nothing all day. And for me, retirement was really retiring from the 9 to 5
The
grind,
corporate
retiring
job. Yeah.
from the need to work to survive,
Hmm.
right? So basically, financial independence was what we were looking for.
Hmm.
I mean, we were working at one of the biggest, if not the biggest, IT company in Canada. And what motivated my wife and I, we were very, very much on the same page with this very early on. So, when you're 19, 20, 21, you start working in a big company, you don't really think of, you're happy, everything's going well, your paychecks are coming in, you just bought a new condo, you finally left your parents' house, et cetera, et cetera. But trust me, after 3, 4, 5 years of working, and you start hitting your 30s, you start questioning things. Am I really going to do this for another 30 years? Like, we saw people in our company that were celebrating 25, 30, 35 years at CGI. They would get a little watch or a clock, and there was a little lunch or something, and my wife and I, we were just looking at each other. We're like, that's definitely cannot be us. We don't want to be doing this for another 20, 30 years. So we decided to aggressively pay down the mortgage just because we didn't know what else to do. It's something that, it's a pretty controversial topic, invest or pay down the mortgage, right? That's a whole other video, a million videos on that. I would say that it's something that can never be wrong, paying down the mortgage, right? No matter what. But at that time, the interest rate was about 3.5%. So obviously you could get more with the S&P 500, but we didn't really know any better. So that's what we decided to do. And like I told you, by 2017, 2018, when the mortgage was about to be finished, we were like, okay, what are we going to do with this disposable income? So that's when we started doing the research, and the rest is history.
At what point did you kind of transition to more about passive income investing, and what was the trigger for that? Like, was it the part of the research that come up, and at that time you
Yeah,
decide that we are gonna get to financial independence sooner?
yeah, it's really the core idea, the birth of the idea, my system, my strategy, my mindset really is predicated on one super simple thing. If I really think about it, replacing your paycheck. We wanted to replace our paycheck. What replace without working? That's passive income. That's literally what it is. So how can we make enough passive income to replace our paychecks? Not to quit your job right away, or it's not really for that. It's to replace your paycheck, so I don't have to go to work if I don't want to. Doesn't mean you'll just quit right away and whatever. But to have the freedom. It's really replace paycheck, freedom, financial independence. That's what really drew me. So the natural thing is you're gonna go towards is dividends, right? Because dividends are technically passive income. You own some stocks, you get a share of their profits, which are dividends. So if you look at my very first portfolio unveil, I'm on portfolio unveil number 40 something now. I do it every month on my channel. But the very first one, you'll see many holdings, including dividend stocks, including REITs, including some covered call ETFs, some split share funds, some fixed income type stuff, maybe 120 holdings, because I kind of took diversification to a really extreme level. But I'm getting a bit ahead of myself. What we decided to do basically is we started getting into these dividend stocks, some covered call ETFs, some split share funds. Once we hit $1,000 of income a month, which is a very, very long and hard milestone to get to. Once you hit at that $1,000 a month, everything changes. It's much easier. The snowball gets quicker and faster. We basically said, okay, this really works. This really works. So we decided to sell off our paid off condo and invest it all in the stock market, about 400, I can't remember the exact amount, 450 maybe. And have go into all these mishmashes of single stocks. I had like CIBC and Scotiabank and Bell, I believe, but I also had like high paying REITs, single REITs, real estate investment trusts. I had some covered call ETFs in there, some split share funds, and I was going, really what I did is I went in my TD broker, I used the screener and just show me all the yields above 5%, 6%, and that's how I was getting a list of these funds, which I had no idea covered calls, or I had no idea really what it was, but I was looking at the yields, and then I would analyze, okay, how long have they've been paying the distributions. And I said, well, let's go all in on a whole bunch of stuff, so I'm perfectly diversified. And that's basically that month. Once we did that, sold the condo, got the money, put it all in, which was end of November, beginning of December 2019 is when we reached our financial independence, because the income basically replaced our paychecks. We were able to live off of just that income. Now that was 3, 4 months before COVID-19. So
Yeah.
it couldn't have been worse timing, but I'm really glad it happened to us because we learned a lot. You could invest for 10 years in a bull market, but you won't learn as much as if you invest during a crash in 1 or 2 months. That's when you're really going to learn about what is your portfolio made of and how they behave during the bad times. And what we quickly notice is that a lot of the high yield, high dividend single stocks, not the banks, but I had other stocks that were giving 6, 7, 8% yield, REITs. Almost all of them, many of them reduced their distribution, their dividend, cut it completely. Some of the split share funds suspended their dividends. That's just how they work. If they go under a certain amount, they suspend. But we noticed that the covered call ETFs, super stable, no problems whatsoever. So throughout the years, 2020, 2021, 2022, 2023, we started graduating, learning more about covered calls. And then, of course, now, as you know, Mo, we're blessed with a million amazing new products that did not exist when I invested it all, 2019. So we slowly transitioned and the portfolio got slimmer and slimmer and slimmer until what it is now, about maybe 6, 7, 4 or 5 core holdings and maybe 7 holdings in all. So that's basically the story.
Yeah, you've definitely streamlined it quite a bit now. And
Yeah.
I was watching as well some of your recent videos that you made. You were talking about first what you dislike about your current holdings, what you then love about them. It was very eye-opening. It seems like you really like the covered calls that are on an introduced on an index. So, for example, Nasdaq covered call or S&P 500. Tell
Yeah,
us
I
more.
came.
Why those ones?
Yeah, so as a long-term investor, once one of the first things that new people need to understand that are new to the stock market, you really have to understand the difference between speculating and investing, trading and investing. For me, Mo, for my personal opinion, you're holding for the long term. You're investing in quality assets without selling them for a really, really long time, like at least 5 years. But I would say to me, it means forever. I don't want to ever sell anything. And that time between 2011 to 2017, when I was doing some swing trading, sometimes I would win, sometimes I would lose, but it was very stressful. It really puts strain on, you're always watching the price because you have to sell it to make any money, right? But you got to think long-term investing. And what I realized over the years of doing this is that almost nothing, I would say 99%, almost nothing beats the big US indexes. Almost nothing beats the S&P 500. Long term, I'm talking about long term here. I'm not talking about short term. I'm talking about 5 years, 10 years plus. Not the S&P 500, the Nasdaq 100 are personally my 2 favorite indexes. We all know what they are. So now we're blessed with these index-based, S&P 500 covered call ETFs, Nasdaq 100 covered call ETF, worldwide. There's many, many of them. So my realization is you might as well go with the best indexes in the world that hold the best companies in the world. So my portfolio is pretty much concentrated in US equities, primarily in indexes, S&P, Nasdaq, with the covered calls. That's the first lesson I learned. The second lesson I learned is that when you put covered calls on anything for the long term, on a good asset that appreciates over time, like the S&P, like the Nasdaq, when you put covered calls on anything, it literally means in layman's terms, you're giving up a portion of the upside for the income, right? That's why, so over time, basically over the long term, they will always underperform the asset that it holds. So S&P 500 versus S&P 500 with covered calls, the one with the covered calls is always going to underperform because the S&P goes up over time. So the fund managers in Canada, I believe Hamilton was the one who started this, and Harvest was a close second, or maybe they started it together. They came up with this genius idea, which I believe is basically the bread and butter or the format of fund that I always go with. Covered calls and 25% leverage, a little bit of leverage. So when you think leverage, people get worried about it. It's technically borrowed money. But it's 25%, which is not a lot. It's a modest amount. It's a very light amount. That's number one. Number two, it's not you borrowing the money. It's included in the fund, which is great. And the fund managers get much better interest rates than if me and you would borrow money from Questrade or from whatever. It's properly managed. It's included in the fund. Of course, you're going to see a lot bigger MER fees with these funds because there's leverage costs included. So that's another thing I keep getting. The MERs are so big. Yeah, but remember, total returns and performance are net of all fees, including MER. So my point of this is really saying that with the 25% leverage, and now we have a few that have been out for 3 years plus, I've noticed that it kind of mitigates the yield return trade-off, right? Because you're getting yield, but you're sacrificing performance or return over time with covered calls. But if you add a little bit of leverage, it kind of brings it up where the S&P 500 with covered calls and 25% leverage gives you very nice yield, but the performance, the actual performance and total return I'm talking about is similar. I'm not going to say identical. Similar. Sometimes it's actually higher in a bull runs, and sometimes it's a bit lower, but over time it's similar to just holding the S&P 500. So to me, that's the holy grail of income investing. I want S&P 500 returns, NASDAQ 100 returns with the consistent income, so I never have to sell anything and just live off the income.
If you were, Adriano, to introduce, like, for somebody who's not as familiar with covered calls in simple terms, and I know you already touched on that to some extent, but how would you define it? And more importantly, what are some of the criteria that you consider when deciding on these? Because these days, as you very well pointed out, there is a wealth of different products being introduced left and right.
Yeah, I'll start with the covered call. So the easiest way to explain it is, that there's a stock market where stocks are traded. There's an options market where options are traded. So these are options on those stocks. So there's two types of options really: a call option, which is a buy option, and a put option, which is a sell option. So when you could buy Nvidia stock or Apple stock or TD Bank and do your own options, sell your own calls on it, which basically means, in layman's terms, I don't want to get super technical, you're giving up a portion of the upside for call premiums, those option premiums, which is what your yield is, which is where that consistent monthly income is coming from, right? It's not magic. It's not coming from thin air. The fund managers, if you're investing in a covered call ETF or an ETF that does covered calls, it's still an ETF that will hold anything you want it to hold, whether it's one stock, whether it's bonds, whether it's an index like the S&P 500, whether it's a group of stocks. Okay, you're still investing in those stocks. Your risk level, your performance, your fate is still tied to those stocks. But when the fund manager is doing a covered call strategy, or let's say you're doing it yourself, you're giving up a portion of the upside. The portion of how much you're giving up really is different between fund managers. That's the key that's what you need to start understanding, because then it's important to choose the strategy that works best for you. The more upside you give up, the more yield you could take in. Like, there's a lot of ones in the US that do let's just say, to make it easier to understand, a lot of covered calls. So they're giving up a lot of upside. You're going to get much higher yield, but if there's a lot of upside in the stock price, you're going to miss out a lot on that action, on that return. In Canada, they typically never go over 50%. Some of them mostly do 33%. So they do a lot less covered calls. So you're getting less yield, less monthly income per se, but you're capturing more upside if that stock goes up. Right, so adding covered calls to anything, by the way, in case people don't know, because they don't know, is this risky? It lowers the risk versus just owning the asset by itself. So S&P 500 versus S&P 500 with covered calls, the one with the covered calls that actually has lower risk, lower volatility, because yes, when there's upside, you're giving up a portion of that upside. But when there is no upside, when the market is flat or it's down, there's a crash, those premiums are kind of like a little cushion. So it kind of lowers your risk, lowers your volatility. So hopefully that makes sense to explain exactly what covered calls are. So in essence, you're actually lowering your risk versus the underlying asset when you're doing covered calls. But I don't invest in covered calls to lower my risk. I invest in them for income. That's the primary reason people invest in covered call ETFs, for the income. Lowering the risk is kind of like a secondary byproduct of it. But I invest in ones that have 25% leverage. That's the format that I like. And the ones that have 25% leverage in Canada, by the way, there's always the regular format, and then there's the 25% leverage format. I would always go with the 25% leverage. So covered calls lowers your risk a little bit, 25% leverage increases your risk. And what I've noticed is that the risk level is similar with those two to just owning the underlying asset. The typical big mistake most new investors make is they just go yield hunting. They'll just go with the ones with the highest yield without understanding what they're investing in, what the covered call strategy is. The most important thing, by far, the most important criteria are the assets inside the ETF. Okay, so S&P 500, NASDAQ 100 with covered calls, MicroStrategy stock with covered calls, Tesla stock with covered calls. You're still investing in MicroStrategy. You're still investing in Tesla. You're still investing in the S&P 500. That will be the primary and biggest determinant, I don't even think that's a real word, of your risk. That determines your risk. Okay, now of course, as I didn't get into it explaining call options, but the premiums that you get, again, you could write covered calls on almost anything now. The premiums that you get is based on the stock or the asset's volatility. That's very important. So the higher the volatility is of a stock or of that asset, the richer the premiums are. This is why Tesla with covered calls, MicroStrategy with covered calls, Palantir with covered calls, Coinbase, these high performing but very volatile stocks, you could get these enormous amounts of yield on those. But then when you do an S&P 500 with covered calls, you're going to get less than half of it because obviously there's less risk, there's less volatility with the SPX, with the S&P 500 versus just Tesla. So the risk level is tied to Tesla. If you're going to, yes, you're going to get 50, maybe 60% yield, 40% yield on the Tesla one. But number one, you have to understand that the yield and the distributions, the monthly dividends or weekly, whatever it is, they're going to vary greatly based on the volatility of Tesla, based on the volatility of MSTR. The lower the volatility, the smaller the premiums are. That's why there could be big swings with the distributions as well. So this is the number one criteria, the assets inside the actual ETF. The more risk you take, the more potential your reward is, but the higher the volatility is as well. And in the covered call world, it means you're going to get higher yield with the more volatile and more risky assets. So personally, I typically stay away from the single stock because to me, it's like investing just in the single stock. That's my risk level. Now, maybe there is some exception. The main exception I did with that is MSTR. So to me, investing in MSTR stock and strategy is kind of like a way of investing in Bitcoin, a leveraged way to invest in Bitcoin. I'm a big Michael Saylor fan. So that's one of the exceptions where I have quite a bit in my portfolio, maybe 7% in MicroStrategy. But that's, to me, it's kind of like a Bitcoin exposure. And right now I have 3 Bitcoin exposures. I have Bitcoin itself, I have MicroStrategy or now Strategy, and I have another ETF from Harvest, which is a collection of Bitcoin-related companies, including Block, Coinbase, Galaxy, Marathon, MicroStrategy, and a bunch of other crypto miners. So I just made those 3 kind of like my de facto Bitcoin exposure. And in my personal portfolio, I decided that my Bitcoin exposure is going to be about 15%. Right now, it's less than that, but in the next couple of months, it should hit 15%. But the only other single stock covered call ETF that I have is the Tesla one, and it's less than 1%. I just did it for fun. Yes, I'm getting 40, 50% yield, but I know that it could vary greatly, and I know the risk level is much higher than USCL or QQCL or HYLD, for example, which is S&P 500, NASDAQ 100 with covered calls and 25% leverage. HHIS is a pretty big hit. It's very, very popular. It has about 25% yield. I look at it as a concentrated NASDAQ 100. So 13 of the 15 stocks are the top stocks of the NASDAQ 100. So you have Apple, you have Microsoft, Amazon, Meta, but you also have some other things like MicroStrategy, Coinbase, Palantir, and some boring stuff like Costco or Eli Lilly's in there too. Now, that group, those 15 stocks, have much higher volatility than the NASDAQ 100. So they're doing the same strategy. They're writing covered calls on a portion of the portfolio. Harvest does typically near the 33% range. They could go up to 50, but they typically write 33%, which means 66% of the portfolio has no covered calls on it. So it just does whatever Tesla does or Palantir does. But HHIS combines 15. So you have more diversification, obviously lower risk than owning just the Tesla, just the Palantir, right? Just the Tesla, you get 40% yield. The Palantir one, you could get more. MicroStrategy is very volatile. You could get, 50% yield. HHIS, you're going to get 25 because there's also Costco in there, right? That kind of lowers it, right? So I look at it as a concentrated NASDAQ 100. That's just how I look at it. So kind of like the Magnificent Seven, right? It's a concentrated top performers of the NASDAQ 100. Now, of course, you're taking more risk because you're more concentrated, but you could get higher reward if those are the dominant stocks in the next 10 years like they were in the last 10, 15 years, right? So HHIS moves very much in tandem with the NASDAQ 100, but if those stocks do better themselves than the NASDAQ 100, it'll do better, right? So again, this is where I tell you, the number one criteria is understand what you're investing in. You got to like those tech stocks. You got to believe in those tech stocks. Or else, why would you invest in HHIS? Most people just see 25% yield. I love HHIS. I'm going to put my retirement in here. I'm going to generate X amount of money. I'll retire. That's not really a good way to think about it. You have to understand what you're investing in and understand that the monthly distributions could change because these are not dividends or call premiums, right? Tesla, MicroStrategy, Palantir, Amazon, these stocks have no dividends.